Hi everyone, I'm James Ayling, an equity researcher here at JM Fin. And in today's market update, I plan to take a look back at 2020, which by most accounts has been an exceptionally challenging year. If I told you global equity markets had fallen sharply by approximately 35% between February and March, against which global coronavirus cases had risen from 76,000 to 340,000 cases, where might you predict equity markets sit as of the 9th of June with now approximately 7 million cases globally? I suspect not back at the levels we'd entered 2020, and yet we are nearly there. To try to untangle this puzzle and make sense of an extraordinary period of market volatility, I plan on walking you through some of the differences we are seeing between Wall Street, by which I'm referring to financial markets such as stock markets and bond markets, and Main Street, by which I'm referring to the health of the broader economy itself. So let's start with Main Street. Facing the exponential growth in coronavirus infections, governments across the world implemented stringent lockdown conditions to protect their citizens and their healthcare systems. As these lockdown conditions swept from Asia into Europe and across into the US, this resulted in a clear drop in both business production, which is a supply-side inflation shock, as well as consumer and business purchases, a demand-side inflation shock. So far, on balance, this has resulted in inflation rates falling. The shock was most apparent in oil, where pricing actually went negative, albeit just for a short period, as oversupply led to global concerns of storage facilities being overrun. Despite meaningful output cuts by OPEC+, the demand shortfall from lockdown has created a supply overhang, which will take time to unwind. These lower oil prices may provide a transitory disinflationary force over, say, the next 6 to 12 months. Moving on to economic growth, we already know the world's largest economy, the US, fell into recession in February 2020. This ended a record 120-month economic expansion. Estimates by the IMF suggest the current coronavirus crisis will be the worst downturn since the Great Depression and meaningfully more severe than the 2008-2009 financial crisis. At the aggregate level, negative growth is expected to hit developed markets more so than emerging markets. And within developed markets, the euro area is expected to take more of the brunt, being more exposed to international trade. The World Bank estimates we are in for the deepest recession in decades, certainly for Main Street. On unemployment, the indicators are less clear-cut. The UK provides a useful case in point. Currently, the UK unemployment rate remains remarkably low at just 4%. Which would imply that the labour market has held up relatively well during this crisis. Yet the Office for National Statistics doesn't count furloughed employees in unemployment figures. So with people on the furlough scheme, approximately a quarter of the UK workforce, should there be insufficient demand for businesses to bring staff back into employment, we could see unemployment spike over 20%. The Chancellor's furlough scheme has been a great bandage, holding back the unemployment bleed so far in this crisis. But what happens as the Chancellor unwraps the bandage from August and starts to ask firms to contribute a higher proportion of their employees' wages? If demand isn't there, unemployment could rise rapidly. As the Chancellor is all too aware, it's going to be a delicate balance as we unwrap the bandage and expose the wound. Nevertheless, the US unemployment report for May provided some overdue optimism as it surprised to the upside. Investors had expected unemployment to rise to about 19% from 15%. However, the result was less severe. Unemployment actually fell back to 13%. This improvement appeared to reflect the gradual easing of lockdown conditions. And if this can be sustained, it might well generate a self-fulfilling improvement. An improvement in the economy can lift business and consumer confidence, which can drive higher spending, which in turn can drive stronger job creation. Let's now turn to Wall Street. Back in February, there were early signs of rising stress across financial markets. In money markets, short-term demand for cash outstripped supply and volatility spread across the broader fixed income complex. Against this backdrop, central banks quickly shifted into easing mode in what, glancing back, appears to be one of the most coordinated global monetary easing events so far in history. Interest rates have been slashed, and central banks have embarked on significant asset purchase programs to provide much needed liquidity into the financial system to calm fears. Investors over this initial fear period sought out more traditional safe haven assets, such as government bonds over corporate bonds, and that caused the spread between corporate bond and government bond yields to widen. Over in equity markets, stress rose from low levels in mid-February to a peak in mid-March, against which equity markets staged one of the most abrupt declines in history. Since March, against a backdrop of highly supportive monetary policy and greater government spending, Wall Street has been flooded with huge amounts of liquidity. Despite a cliff of investor concern in fixed income markets, government bond yields have moved a little higher, but more importantly, volatility has reduced back down to more normal levels, and the spread of corporate bonds to government bonds has compressed. Equity markets have also staged an impressive recovery. Developed market equities are now within touching distance of their 2020 highs, despite meaningful earnings cuts for the year. Emerging market equities have also rebounded, although, like developed markets, performance within emerging markets has been somewhat more mixed. Asian markets have recovered more ground than their Latin American counterparts, who have struggled more so with the impact of controlling the spread of coronavirus and have been more severely impacted by lower commodity prices. Elsewhere, gold has risen as demand for more traditional safe haven assets remains elevated. The relative cost of holding gold has reduced, and alongside this, rising monetary and fiscal easing could result in an unexpected long-term inflation runaway. So is Wall Street being complacent? Well, if you just look at equity markets based on this year's earnings, it certainly seems fair to call the market expensive. Earnings in the second quarter of this year are going to make for some quite uncomfortable reading, but investors largely know this to be the case. Instead, as investors, we attempt to value companies by discounting the stream of future earnings a long way into the future. A gradual phased reopening supported by ample liquidity can keep this party going as we move into a new normal. But I suspect for Wall Street, we could be in for a choppier ride ahead. As for the risks that could derail the recent Wall Street recovery, well, you have geopolitical tensions, particularly between the US and China. We also have the upcoming US presidential election alongside the current civil unrest. We could face a second wave of coronavirus after the summer into the winter flu season. We could also see policy mistake from the premature withdrawal of either monetary or fiscal support. And let's not forget, for UK investors in particular, Brexit negotiations are meant to be happening now. So in terms of takeaways from this Wall Street and Main Street analysis, what do we have? Well, the coronavirus pandemic started as a health and economic crisis, unlike the 2008-2009 financial crisis. The global economy remains on unprecedented monetary and fiscal life support. As we remove these support mechanisms, only then will we know the true extent of the damage, as it will become clearer. On Main Street, we are likely to endure a period of weak growth. We may experience disinflationary pressures over the short term, but risks of higher inflation long term have risen, and the outlook for unemployment is less clear. On Wall Street, valuations have become more expensive. Corporate profits aren't going to look good this year, but financial assets on Wall Street constantly seek to price in the future. A disconnect between Main Street and Wall Street may be able to persist, but only if supported by the euphoria of copious amounts of liquidity and a gradual reopening of the economy. On balance, downside risks seem elevated and underpriced relative to the upside potential for markets at this point. And finally, the crisis has accelerated some important existing investing trends. For instance, e-commerce growth has been accelerated from coronavirus and forced customer adoption, and this may well accelerate the e-commerce growth trend into the future. Elsewhere, businesses may need to reevaluate the resilience and global interdependence of their supply chains. And remote working has in some sectors proved to be much more successful than expected. This may accelerate the trend towards more flexible working and could raise concerns about the real value of prime city real estate.